In this video, we're going to cover real briefly when to recognize revenue in a transaction. The basic general revenue recognition rule is that revenue should be recognized when the goods have been delivered or the services have been performed. Now, I want to make a note here. We are just covering this at a very basic level. Once you get into intermediate accounting, there's lots of nuances and lots of choices to make. But here we're just going with this general revenue recognition rule. Let's go through two examples. So first of all, example one. Kent Coffee sells a $25 gift card to Janae Smithers on October 3rd. Janae uses $10 of the gift card on November 2nd and the other $15 on December 8th. So the question is, does Kent Coffee have revenue on October 3rd for this gift card? What do you think? The answer is no. Kent Coffee has a liability on October 3rd. It would record that transaction as debiting cash to increase assets and crediting unearned revenue to increase a liability. It owes $25 until it performs the service or delivers the goods. Let's go on. Next question. Does Kent Coffee have revenue on November 2nd when Janae uses $10 of the gift card? What do you think? The answer is yes. Kent Coffee would have revenue on November 2nd for the $10 that she used. So Kent Coffee would debit unearned revenue, which decreases liabilities for $10, and it would credit sales revenue, which increases revenues for $10. Let's go on for one more question here. So Kent Coffee, again, same transaction, but now we're looking at the $15 that she uses on December 8th. Does Kent Coffee have revenue on December 8th related to this gift card? The answer is yes. It would record the December 8th transaction as debiting unearned revenue, which decreases liabilities for the $15, and then credit sales revenue, which increases revenue for the $15. So we're done with that example. Let's go on to another one that's a little more involved. In this one, we have Kent Furniture manufactures a sofa that is in high demand and is on back order. The price of the sofa is $1,000. Customers pay a $50 refundable reservation fee to be on a list to get an invitation to order the sofa. Once the customer is invited to order a sofa, the customer pays a $300 deposit to order the sofa and then will pay the balance when the sofa is delivered. So basically, I've laid out all the dates associated with this example. So the first date, April 3rd, let's look at the impact. April 3rd, Connors pays a $50 reservation fee to Kent Furniture. The impact on Kent Furniture's financial statement on April 3rd is to increase assets for the cash it received and to increase liabilities or unearned revenue for the $50. That's that reservation fee. It's refundable. They haven't earned anything yet. They haven't delivered anything yet. So let's go on to the next date. So May 12th, Connors receives an invitation to order a sofa. There is no impact on Kent Furniture's financial statements. They have not done anything to earn any revenue. Nothing has changed hands. They just sent an invitation to have the customer order a sofa if they want to. Moving down to May 15th, Connors pays a $300 deposit and orders a sofa. So on that day, Kent Furniture increases its assets for that cash of $300, and it's also going to increase its liabilities, that unearned revenue for $300. It doesn't have revenue yet because it hasn't delivered the goods. Moving on then to August 4th. August 4th, Kent Furniture delivers the sofa and collects the balance due in cash. So they are going to, first of all, receive cash for $650, which is the $1,000 price less the $50 fee they already collected and the $300 deposit. They're going to increase revenue by $1,000. Now they get to recognize the revenue. And they will also decrease liabilities. They're decreasing that unearned revenue because they have delivered the goods now. So they no longer have this liability of $300, which was the initial $50 fee plus the $300 deposit. So I hope that was helpful. That's it on this video. Have a great day.